Accounting chapter 12. Accounting for depreciation and disposal of non-current assets. As a business, you would have acquired different non-current assets. You know what non-current assets are? These are assets that can last for more than a year within the business, right? We're talking about machinery, we're talking about land, we're talking about building, we're talking about plant, we're talking about furniture and fittings. So these are non-current assets. They could last for more than a year. So this is where depreciation comes in. So what is depreciation? Depreciation is an estimated loss of value that current assets would have over its economic life. So, or for example, the building. Land does not depreciate. Land appreciates. But other non-current assets will depreciate, like machinery, like fixture, like equipment, like plants. They all depreciate. So the estimated value of the estimated loss in value of a non-current asset over its economic life is what we call depreciation. So how how those assets, the non-current assets, will start losing value over the time that is being estimated that it's going to spend. That is what we call depreciation. So we could also say it's what the wear and tear of an asset. Is it clear?
Yes.
Okay. So let's just go down. Introduction. As explained in chapter 11, it is often necessary to include year-end adjustment in the set of financial statement. This ensures that the account provide a more accurate view of the profit or loss of the business and the financial position of the business. So for reliability, for accuracy, we need to include a year-end adjustments. That's why we have repayment. That's why we have accrued. So that we can have a realistic value of our financial statement. So if we are doing that, we also have to put into consideration the wear and tear of those assets because we continue to use them because of operations. So the machinery we bought today or this year will not be the same as 2 years time. So we should start putting into consideration its depreciation value. That is what they are saying here. So this is where depreciation comes in. So this chapter focuses on year-end adjustment made for depreciation of non-current assets. Depreciation. Depreciation is an estimate of the loss in value of a non-current asset over its expected working life. The working life is called the economic life. So the lifespan of that non-current asset or the lifespan of equipment, how does it start losing value? That is what depreciation is going to talk about. So we are calculating the loss in its value over its economic life. I think it's clear.
Yeah.
Okay. So most of non-current assets of a business
Yes.
okay. Okay. So most of the non-current assets of the business lose value over a period of time that they are used by the business. If the accounting record continues to show these assets at their cost price, then the account will provide misleading information. We continue to use that. We've bought this equipment. We cannot continue to write the same cost of the equipment. We can't continue to write the historic cost for each year that passes by because that asset will wear and tear. So if we are writing the same value of equipment for last year as the same value of this year, the same value of next year, we are giving a misleading information. It's just as if that we are not using that asset. But because we use the asset will wear, the asset will tear. We will maintain the asset. So expenses will be incurred with this asset because these assets are being used. As a result, we should always put into consideration the value of loss that this asset would cost because of its usage. If not, whatever information we give, they are misleading. I think it's fair.
Yes.
Yeah. So, if accounting, okay, now this said the record can only show an estimate of the loss in value of a non-current asset because of depreciation. The exact amount will only be known when the asset is disposed of or sold. The equipment will continue to give us a value in terms of depreciation. But okay. So the records can only show an estimate of the loss in value of a non-current asset. The only time we can know the value of that asset is when we dispose that asset. So in as much as we are still using that asset, we can't know the true value until when we want to dispose it. That is when the true value will come. So you bought it for 10,000. It will start depreciating, yes. But that doesn't tell you that that is the value of it now. The day you want to sell that asset, the day you want to sell that equipment, that day is when you know the real value at that time. Because people will come up with a value. They'll tell, oh, we can't buy it less than 6,000. Yeah, you purchase it for 10,000 or 12,000, but it has depreciated. So different people will come up with different prices. So that's why they say the exact amount will be known, will only be known when the asset is disposed of or sold. Building depreciates over time, but land does not usually lose value unless it is something like a well or mine when the value is removed from the land. Land does not depreciate. Land do appreciate. The only time land depreciates is when it becomes like a mine or what did they say? A mine or a well that what is valued, the value in it is taken away. Like maybe there's gold, there's diamond, there's oil. So at that point in time, that land has value because of those those things, those resources inside. But as soon as those resources goes out of it, as soon as those resources are extracted, the land loses its value. That is when land depreciates. Aside that, land does not depreciate. I think it's clear. Yes. The purchase of now go. The purchase of a non-current asset is capital expenditure. So a business, like we said, would have invested in non-current assets. So the investment in non-current assets is called capital expenditure.
It's a consumer
Capital expenditure, revenue expenditure. When you invest in, day out,
there's custom something. Customer expenditure.
consumer goods, capital goods. No,
Oh yeah, no.
This is capital expenditure. Are you with me?
Yes, yes.
So we call it capital expenditure because it's an investment in a non-current asset. Is it clear?
Yes.
Good. So the cost of non-current assets is not charged as an expense in the year of purchase, as it benefits the business for several years. Matching the capital expenditure against the sales, it has helped the business when it's done by an annual charge for depreciation. So when you buy an asset, that financial year, you don't find or you don't work out its depreciation. You can't. It's a new asset. It does not have depreciation. So you have to record it with its historic cost. But as the year passes by, it starts depreciating. That is when you have to match the capital expenditure against the sales. Do you understand? So to match it, that is when you talk about depreciation. Is it clear? Yes. So the depreciation for the year is included in the expense in the income statement. So the profit for the year is not overstated. This is an application of the principle of prudence. If the profit is overstated, the owner of the business may be tempted to withdraw more cash than the business can actually afford. The problem about overstating your profit is that when you overstate your profit, as the owner of the business, you might be tempted to withdraw more than what the business can afford. That means because you think you have more. The profit belongs to the owner of the business, no doubt.
Yes.
But because you have overstated your profit, you think you have more money available, then you take all. At the end of it, you might start having problems of liquidity. So there's a principle of prudence. You must not overstate or understate. You don't overstate your profit and asset. You don't understate your liability or loss. Because if you do, you'll be tempted to take more than what you have, more than what the business can afford. Is it clear?
Yes.
That is the point they are making here. So the principle of prudence is also applied in the statement of financial position as the non-current assets are recorded at a figure less than the cost price. This is known as the net book value or the written down value. So when you are preparing your financial statement, you less the cost price from the current assets, the record of the current assets. That means it says the current assets are recorded at a figure less than the cost price. So the historic cost, this historic cost, and you have to understand the net present value, the net book value. You have to take it away. So you record it with that. So you have depreciation. You have there's cost of depreciation. Yes or no?
Yes.
There's the estimated value
Yes.
for that asset. There's the original value for that asset. You take them away. So what is left is what you record in your financial statement. If not, you would be overstating. Do you get the point you're making there?
No.
No. It said the principle of prudence is also applied in the statement of financial position as non-current assets are recorded at a figure less than the cost price. So you don't record, I told you, when you are recording your financial statement,
Yes,
you have to record it with the net book value,
Yes, yes.
which means you have taken cost away from, you have taken the expenses incurred
Yes, yes.
on that asset from the asset, the value of the asset,
Yes, so take the profit,
not profit.
the net profit.
Equipment has a value.
Yes.
The cost of maintaining that equipment has a value.
Yes.
So the cost of maintaining that equipment, you have to take it away from the value of the equipment.
Oh, yeah.
That is what you record. Is it clear?
Yes, yes.
You get the point I made there.
Yes.
The prudence means the cost of an asset. You have to take it away from the expenses incurred on that asset. That means the cost of maintaining that asset. You have to take it away from the historic cost. That is the principle of prudence. Okay. Now go to the causes of depreciation. What brings about depreciation? The four main causes of depreciation are physical deterioration, economic reasons, passage of time, and depletion. So we start with physical deterioration. What is physical deterioration? This is what we call the wear and tear of an asset. Look at it, the physicality about it starts tearing, wearing, that you can even say, oh, no, this is an old item. This is an old equipment. So here they said, this is the result of wear and tear due to the normal usage of the non-current asset. It can also be because the asset falls into a poor physical state due to rot, decay, and so on. Assets will deteriorate, especially plant equipment, if they are exposed to things that would make them rust, things that will make them rot, things that will make them decay, then they will depreciate. Do we get it?
Yes.
So they're going to lose their physical state due to rot, due to decay, due to rust. I think that is clear. So if this happens to an asset, if this happens to a non-current asset, it means it is depreciating. That means that asset has depreciated. The second one, economic reasons. Non-current asset may become inadequate as it can no longer meet the needs of the business. It can also be because the non-current asset has become obsolete as newer and more efficient assets are now available. Another reason why we have depreciation is obsoleteness or economic reasons. So for economic reasons, we're talking about the asset does not fit in the demand of the business. Oh, we have an equipment that produces 10,000 units, but these days we need an equipment that could produce 30,000, 40,000 units. That asset cannot do that anymore. That is economic reason. Then we talk about the obsolete. For obsolete, it means that this asset does not fit in into it doesn't fit in into the industry anymore. There is advancement. There's advancement in technology that this asset becomes old. Okay, it's gone. It's nobody uses it anymore. Do you see what we're talking about here? We're talking about the first one is they are both economic reasons, but we just try to split them. Talking about economic reason being that the asset or the non-current asset does not fit in the demand of the business anymore. That's the first reason. The second one is obsolete, which means that that asset becomes so old that new ones have evolved. So when they see you using still that old one, that means your business is not serious. As a result, that asset has depreciated. That's the second point. Is it clear?
Yes.
The third point is passage of time. This arises when a non-current asset, for example, a lease, has a fixed life of a set number of years. Passage of time. It can only spend 5 years. You've taken it for 5 years. As soon as 5 years is done, it depreciates. You can't use it anymore. Do you understand?
Yes.
That's passage of time. And the last one is depletion. This arises in connection with non-current assets such as wells and mines. The value, those things that makes them what they are, has been taken away from them. So they become empty. The land become empty, the well become empty, the mines become empty because they've extracted those things that make them to have value. That is depletion. Is it clear? So these are the reasons for depreciation. Any question about that?
No.
Yeah. So go to the methods of calculating depreciation. There are several methods used. Okay. There are several methods used to calculate the estimated loss in value of non-current assets. Different types of non-current assets are often depreciated using different methods. The method selected should be one which spreads the cost of the asset as fairly as possible over the periods which benefit from its use. So whenever you have to use a method, we ensure that the method you are using will be able to spread the cost as fairly as possible. Use a method that will suit your financial statement. That is the point. Is it clear?
Yes.
That brings us to what they call the principle of consistency. It says when you choose a method that suits your system, make sure you don't change that method. That's the principle of consistency. Do you remember the principle of consistency? We talked about the accounting concepts and conventions. We talked about prudency, we talked about matching concept, we talked about entity, we talked about consistency. This is consistency. Choose a method that suits your financial statement. And as soon as you choose that method, continue to use the same method. Don't switch methods. That is consistency.
Yes. Yes. In accounting world.
Yeah. So that is what we have to apply here. In practice, many factors are considered before a decision method is selected. How long is the asset expected to last? How much will the asset be sold for when it is put out of use? How can the benefit from the use of assets be measured? So when you have to consider using the method you have to use, you have to put it into consideration. The first thing you have to put into consideration when you have to choose the kind of method of depreciation you want to use is first the the expected lifespan of that asset. The first one. How long how long is the economic life of that asset? That's the first thing you put into consideration. The second one is how much are you going to be able to sell that asset when finally you put it up for sale? That's the second point you have to put into consideration. And the last one is how can the benefit from the use of assets be measured? So how do you want to measure how beneficial that asset was before you sold it? So these are the three things you put into consideration before you use the kind of method you want to use. So what are the kind of methods available for depreciation? The first one is the straight line method. The second one is the reducing balancing method. And the third one is the revaluation method. So we start with the straight line method. For the straight line method, the formula is the cost of sales divided by the number of expected years of use. That's the economic life. Are you with me?
Yes.
Okay. So we start with the straight line method. This is known as the fixed installment method. The formula used for calculating the annual depreciation using this method is the cost of assets, that's the historic cost, divided by the lifespan. Clear, right?
Yes.
So this expresses the annual depreciation of as an amount of money. The answer is to this formula is expressed as a percentage of the total cost. This method applies to the same amount of depreciation or the same percentage rate of the cost price each year. The value of the asset can fall to nil if there is no residual value. See below. So when we talk about residual value, we're talking about the value the constant value, the value that will be taken away each year. Because each year it will be the same.
Yes.
So let's see. They said Capital's financial year ends on 30th June. On July 1, are you there?
Yes.
On July 1, 2023, she purchased fixtures costing 25,000 paid by check. She estimated that she would be able to use the fixture for 4 years. So the economic life of that fixture is 4 years. The historic cost of that fixture is 25,000. Now calculate the annual amount of depreciation as an amount of money. To calculate it as an amount of money to be what? The cost of asset divided by the numbers of years, the expected lifespan, which is 25,000 divided by 4 years. So 6,250 is the amount of depreciation. Is it clear?
Yes.
So when we calculate as a percentage, to calculate as a percentage, it should be what? The residual value divided by the cost. You get it?
Yes.
Did you get it, please?
Yes. Yes.
Okay. Now, let's go to the residual value. We said the residual value is what? The value of the non-current asset at the end of the useful life. So that's the value that is left when that asset is done. So where it is estimated that the asset will have some value at the end of its working life, this must be included in the calculations. Such a value is known as the residual value. The formula then becomes the cost of sale, the cost of assets minus residual value divided by the number of expected years. The number of expected years. You get it?
Yes.
So let's go back to Capital. Capital financial year ends on 30th of June. On 1 July 23, she purchased fixture costing 25,000. She estimated the fixture to last for 4 years. And she's expecting to sell them at $3,000. So the $3,000 is what? The residual value. So how do we now calculate our depreciation? To calculate the depreciation to be 25,000 minus the residual value divided by the total number of years. So the cost of depreciation will be 5,500 as an amount. As a percentage based on the original cost, it will be the cost of depreciation divided by the historic cost multiplied by 100. I'm going to explain it. You got it?
Yes.
Then we move on.
Yes. Just
Okay.
that's one of these is chapter.
Huh?
Depreciation.
Depreciation, right?
Yes, because you have to know the formula. That's
And that's all. So let's go to the reducing balance method. For reducing balance method, every year that passes by, you decrease the value of depreciation.
Yes.
So they said here, as the name implies, the amount of depreciation reduces each year. The same percentage rate is applied, but it is calculated on a different value each year. So if it is 5%, it is 5% all true. But at each year that passes by, the value that you calculate the 5% with will be different.
Yes.
Is it clear?
Yes.
So at the end of the first year, the depreciation of that year is calculated on the cost of assets. Depreciation for the following year is calculated using the same percentage on the cost of asset less depreciation of the previous year.
Yes.
Then we're going to get our net book value. So look at it. Let's just go down to the question. Capital financial year ends on 30 June. On 1st of July 23, she purchased fixture costing 25,000 and paid by check. She estimated that she would be able to use the fixture for 4 years and the residual value would be at $3,000. Calculate the depreciation for each year of the 4 years of the fixtures economic life using the reducing balance method of 40% per annum. So the cost of depreciation is 25,000. The book value will be what? 25,000 minus 3,000 divided by 40. That's 10,000.
Mm.
So 10,000 minus 25,000 gives us 15,000. Now we start again. 15,000 divided by 40%. We start again. 40% by 9,000. We start
So
depreciating.
you minus the first one, 25 minus 3,000 and then divide it by
40%, yes.
The next one you should do the same thing or no? Or
Yeah,
is it-
depreciation for the year, and yeah, you start deducting from it.
no, with the residual value or no? Second one.
For the second year, the original value now will be 40% of it. 40
For the
over
first-
100 multiplied by 15%.
You always do the first one with you subtract from it 3,000. Is it the residual value?
Yeah, because that's the residual value.
It affects only the first value.
Yes,
And then it will be only percentage.
only percentage. So look at it. We have, do you have a calculator there? Okay. So for the depreciation, reducing balancing method, each year, the historic cost divided by the percentage for each year. So the value starts reducing. At the end of 4 years, At the end of 4 years, you compare the cost in 4 years. That's the book value. That's what we call the book value with the residual value. You get it?
Yes.
You compare the book value with the residual value. That's when you know that if the asset is worth it or not. Is it clear?
Yes.
Now go to evaluation. When we talk about evaluation, here we're talking about the asset itself. This method is used where it is not practical or it is difficult to keep detailed records of certain types of non-current assets. If detailed records are not available, then the straight line and using balance methods of depreciation cannot be calculated. We use evaluation when we cannot measure the assets. Okay, let's see what they say. They said small items of equipment used in offices and laboratories, packing cases, loose tools, etc. are usually depreciated using the evaluation method, as no detailed records are kept for this asset. The assets are valued at the end of the year. This value is compared with the value at the end of the previous financial year, or with the cost if it is the first year of ownership. The amount by which the value of asset has fallen is the depreciation for the year. So, for example, like calculator, what value do you want to, what depreciation you want to talk about calculator?
Depreciation.
Yeah, it's difficult because these items are little items.
Yes,
Do you understand?
depreciation.
Look at what they said. Let's look at the question. They said, capital financial year ends on 30 June. She purchased fixtures costing 25,000.
Yes.
She decided to revalue the fixture at the end of the year. The cost of the fixture is 25,000. Value of the fixture is 20,500. So the depreciation is 20,500 minus 25,000.
That's depreciation for 1 year. So
That's
4,000.
4,500, yes. This is how we evaluate the cost of the assets and the value that you are going to value. Like, okay, it should be maybe in the next 3 years, it should be this value. So you take it away from me. Yes. You take it away from me, that's evaluation.
Yes.
Do you get it or not?
Yes, it's a good thing.
They said 25,000 is the cost of assets. She revalued it to be 20,000. She valued it to be 20,500. So here, you can't estimate, you can't figure out the value it could be. So you think in your mind that, oh, this phone will be like 2,000 next year, but you bought it 5,000. So your depreciation will be 5,000 minus 2,000. You understand evaluation there?
Yes, yes.
Clear, right?
Yes, yes.
We'll go to recording depreciation in the ledger. Are you there?
Yes.
Recording depreciation using the straight line method and reducing balance method. The procedure for entering depreciation calculated using the straight line method and the reducing balance method is exactly the same. Each type of non-current asset has two ledgers. An account of recording the cost of the asset and the account of recording the depreciation of the asset. Those are the two ledgers. So how do we record the assets? The asset account always has a debit balance and the provision for depreciation always as a credit balance. So the asset account has a debit balance, but you make provision for depreciation. Provision for depreciation means that, oh, in the next 3 years, this value is what we are going to spend on this asset. We call it provision for depreciation. It's always an expenses.
The asset is always yeah.
It's credit.
No, the asset. Asset account is debit.
Yeah, the asset account is your provision for depreciation is what I'm talking about. Are you with me?
No,
You know that. At the end of the year,
yes.
at the end of the year, you make provision for depreciation. Provision for depreciation is like a certain amount of money set aside for depreciation. That is provision for depreciation. Your asset, that asset that you are making provision for depreciation, will be on the debit side. It's an asset account, it's a debit balance.
Yes, yes.
But the provision made for that asset should have a corresponding credit.
Yes, this is a good thing.
So these two accounts must always be considered together. The difference between the balances of this account represents the net book value of that asset. So the difference between, I told you, when you are preparing an asset,
Yes.
when you are preparing your statement of financial position,
Yes.
you have the assets.
This is
And you need to, you have the provision for depreciation for that asset.
Yes, yes.
The provision for depreciation for that asset, you take it away from the asset. That gives you your net book value that you have to record in your statement of financial position.
Yes, good. So the end up value we put in the set of financial position.
So if you don't, that means you're not prudent.
You're either understated or
Overstated.
Yes,
I think it's clear.
yes, it is.
At the end of the year, your income statement, you have to debit your income statement and credit the provision for depreciation account with the depreciation of the for the year. If
Yes,
it's 3,000, you record it 3,000. Is it clear?
yes, yes.
With this question, you understand what I'm saying. Capital financial year ends on 30 June. On 1st of July 2023, she purchased a fixture costing $25,000 and paid by check. She estimated that she would be able to use the fixture for 4 years and then be able to sell them for 3,000. Capital decided to use the reducing balancing method of depreciation of 40% per annum.
That's reducing balance.
Reducing balance method. So when you have to prepare your fixtures account will have a debit entry of 25,000.
Yes.
That's your nominal ledger. That's the first account for 25,000.
Yes,
Debit.
it's bank and
Now you have to prepare your provision for depreciation account. Your provision for depreciation account will have the income statement. On the credit side, we said when you are preparing your provision for depreciation account,
yes,
you credit the income statement.
it's pretty
And because you have debited the account itself, the nominal ledger for that asset.
yes.
The asset has a debit balance. The provision for that asset must have a credit balance.
This is it.
If not, then something is wrong. Now, for your provision for depreciation, which has a credit balance in the income statement, the balance carried down, you balance it, which is the same amount, 10,000. Now, on June 30, reducing balancing method, 25,000 or 40%. 25,000 or 40%.
This one. This.
Yeah. We use reducing balance method, yes or no?
Yes.
For the first year, it is 10,000.
10,000. Yeah.
The second year, 40% of 25,000.
It's 16.
Yes.
No. It's after the
Look at what they have here. 25, yeah, it's 40%.
40% minus the 20. So
Yeah.
16, yeah.
16,000.
Okay, yeah.
The third year, 40% of 16,000 minus 16,000. Can't you see that? This is reducing balance method.
Yes, yes.
So each year that passes by, you reduce the balance method and you balance it up. Year one is 10,000.
Yes, year two is 16,000.
Yeah, which comes at 6,000. The balance is 16,000, but 16,000 minus 10,000, 6,000
Yes, yes, yes.
is reducing. The debit side, the credit side of your income statement will state the value of depreciation, not the debit side.
Yes, I get you.
Do you get it or not?
Yes, yes.
16,000 minus 10,000, 6,000. 19,600 minus 16,000, 3,600. The value of the asset, the loss in value of that asset is on the credit side of the provision for depreciation. We said there's provision for depreciation.
Yes.
So that means on that statement, it should be reducing 10,000 year one, 6,000 year two, 3,600 year three.
Yes, yes, yes. Okay.
That's the provision for depreciation. So at the end of the year, 2016, the value, you take it away from 25,000. The total value is what? 19,600.
Yes.
That's the value after 3 years. Yes or no?
Yes, the total value will be 21,760 because it's 27 is the last
The
year.
balance brought down is 19,600.
Oh, yeah. The balance brought down.
The difference between 19,600 and 21,700, which is the total value of that asset, gives you 2,160. That's the book value of that asset.
Yes.
Do you get it?
Yes, yes, I get it now.
So at the end of the year, in your record, you have in your statement of financial position, you have 2,160. But in your income statement, you have 21,760.
Yes.
Is it clear?
It's in debit side.
Yeah, the debit side, yes. Is it the debit side?
And the second financial position is in non-current.
This is
asset.
balance brought down
Yes.
for July 1. Your income statement to be debit side for that amount.
Yes.
So, go down, please. Where a non-current asset is purchased during the financial year, the business may decide to charge depreciation from the date of purchase. This means that in the first year of ownership, only a proportion of annual depreciation will be charged in the income statement. Here, they are telling us that sometimes you might charge depreciation from the first year of purchase of assets. But what could mean, why would we do that? Here they said, on July 1, she purchased a motor vehicle costing 9,000 and paid by credit. Motor vehicle, okay. An additional motor vehicle costing 8,000 was purchased and paid for by credit transfer. She said she decided to use the straight line method of depreciation for 20% depreciation to be calculated from the date of purchase. So we have the motor vehicle account for two motor vehicles.
Yes.
9,001. The first one is 9,000, the second one is 8,000. The balance of this, we go to the balance will be 17,000 for the two motor vehicles that were bought, right?
Yes.
Now the position for depreciation was set at what? 20%. Isn't it?
Yes. Yes.
So if it is set at 20%, 20% of 9,000, 20% of
You
8,000.
said that they use the straight line method. It's not the straight line method. It's a reducing balance method.
No.
Because you're reducing 20%.
Should I to use straight line method?
Depreciation at 20%. And
Yeah.
yeah, just select one.
The one, huh?
3, 2. See us. Yeah, the draw. The draw. If it wasn't for that red card, I think they would win. Nottingham Forest. I think they would win. They would win. They give it the
Yeah, card.
yes.
Okay.
Let's go. 70,000
Please don't give it the same.
times. I think yeah. Five. Yeah. This. Oh, 70. Yeah.
Okay.
So yeah.
So for recording depreciation using the revaluation method, for evaluation method, we talked about it. You have the value of your assets, then the estimated value the asset will be after some year, after 4 years or what.
Yes, sir.
That's what you take away from each other. Okay. Now, when you have to record the depreciation, when you purchase the assets, during the year you purchase the asset, you debit the asset account
Yes, sir.
and you credit the cash book because the cash book is paying,
Yes, sir.
or you credit the supplier's account with the cost price.
Yes.
Clear?
Yes, sir.
At the end of the financial year, you credit the asset account with what? The value of the asset. Because it's going on depreciation, right?
It's the same value as the first.
The value of the assets.
That value.
At that date, at the end of the year,
This is at the
it
end
can't
of
be
the
the
year,
same as it can't be the same as historic cost.
after the depreciation. Yes.
That is the value you credit it to.
Credit in the assets account.
on the credit side now. For the at the end of the year, we're talking about at the end of the financial year.
Yes, yeah,
So as soon as that is done, you find the difference between them. That will be your debit balance, which you write on the debit side.
the side on the assets.
Yeah, because the value of assets will be on the credit side. Now your income statement will come back to the debit side. Reciprocal.
Yes.
The first one during the year, it has the asset has a credit debit. The income statement has credit. At the end of the year, you start making your accounts. It has to come back to debit.
Yes, yes. Yes, I get. So it's the assets account. So it's debited the value for the value of that.
The value of that asset
No, for the value of that. Yeah, the value of that.
at that date.
Yes, to be debited.
It will be
And
debited.
then after depreciation, it will be the credit amount of the depreciation
On the credit side.
on the credit side, and then the income statement to balance.
Yeah, the value.
Yes, the value.
That small value goes to your income statement.
Yes, I get.
There are two things here. The asset has its cost. It has its cost of depreciation. When you are recording your income statement, you record the value. When you are recording your income statement, you record the value of the provision for depreciation, which you will get when you have used either reducing balancing method or straight line method. So that value goes to your income statement. But your statement of financial position will be that value that goes to your income statement minus the total cost, the value of that asset. The asset is 10,000. The provision for depreciation amounted to be 3,200. The net book the net book value will be recorded in your statement of financial position as 10,000 minus 3,200, which is 6,800. That's the net book value for that asset. Your income statement will be recorded as 3,200. The historic cost is gone.
It's a good thing.
Okay. So here it said on 1st of July 2023, she purchased fixtures costing 25,000 and paid by check. She decided to revalue the fixture at the end of the year. So the fixture is valued as 20,500.
Evaluation.
So
Evaluation.
yeah,
It's a
revaluation, yeah.
evaluation.
And for revaluation, what do we do? The difference between the historic
value.
cost minus the estimated value.
Yes.
So
It's 4,500.
500. That's what goes to your income statement.
Yes. See.
I think it's clear. So here we stop in accounting. Go to disposal of non-current assets.
No, we're not there.
Okay.
We're at recording depreciation financial statement.
Okay, yeah. Recording depreciation for the statement of financial position, right?
Yes, yes.
Okay. I explained it already. In your statement of financial position, the depreciation value,
Yes.
depreciation of fixtures, that's the amount. The expense is the amount provided for depreciation. That is just it. Look at it. Let's just go to the question. It said on July 30, on July 1, 2023, she purchased an asset for 25,000. It's depreciated at 40,000. Yes or no?
Yes.
Good. What is the depreciation of fixtures then? 25,000 or 40%, which is 10,000.
10,000.
Yeah. Yes or no?
Yes, yes.
10,000. Good. So the expenses is how much?
10,000. Depreciation of fixed. That's the.
Provision for depreciation
Yes.
will be how much?
10,000. Ah, to be 10,000.
40% of 10,000 again. 40% of 10,000.
Yes, it's
4,000. 4,000 minus 10,000, 6,000.
What is that? Oh, 40% of 10,000. Oh, yeah. It's,
The first year is 25,000. 40% of 25,000.
Oh, yeah. 6,000. 4,000.
20%. 40% of 25,000.
40% of
25,000.
10,000.
10,000.
And then you're going to do 40% of 10,000.
40% of 10,000, 6,000.
40% is 4,000.
It's 4,000 minus 10,000, 6,000. So your depreciation, your expenses, the first year, the second year will be, the first year will be 10,000, the second year will be 6,000. I think that is clear.
The financial statement, what is it?
Yeah, at the end of it, you prepare your financial statement.
What's accumulated depreciation?
Hey, where are you, Abdullah?
I didn't get
Accumulated depreciation is the provision for depreciation.
same thing.
Yeah. How is it accumulated? It's accumulated because we have
Oh, yeah.
the value. We said the value of the historic cost minus provision for depreciation gives you your net book value.
Yes, yes.
So this year we have 10,000 as depreciation. Yes or no?
Yes, yes.
10,000 minus historic cost gives you an NBV. That is what they are saying.
That book value, yeah, I get it.
So in your statement of financial position, you record 15,000. In your income statement, you record 10,000. The historic cost is gone. The historic cost stays with the first year. As soon as the first year is done, the next year has to go with depreciation. Then there's a value of depreciation, which is 40%. So 40% of 25,000 is 10,000.
Yes,
That's the accumulated
so
depreciation.
that will be in the income statement.
Yeah, income statement. And you have to take it away also from the statement of financial position.
2,000. 2,000 being
10,000 minus 25,000
yes, yes.
goes to your statement of financial position as the net book value.
Yes, the net book value will be 15,000.
Yes.
That's it, yeah.
The income statement will read 10,000. That's accumulated depreciation
Yes, yes.
or your provision for depreciation.
Yes, yes. So the same thing, yeah.
Yeah.
Yeah, yeah.
Is it clear now?
Yes, yes.
So for the other asset is 9,000. The same thing because there are two assets there. One goes for 6,000, one goes for 10,000. So you have the net book value.
Yes, yes.
Is it clear?
Yes.
All right. So here we go to 12.9. They say capital financial year ends on 30 June. Yes or no?
Yes.
She depreciated her fixture using the reducing balance method for 40% per annum. Her trial balance drawn up included 25,000 fixture, provision for depreciation 16,000. So how do you prepare this? 40%, right?
Yes, 40%.
40% of 25,000.
It's 10,000.
10,000, right?
Yes.
But here they said prepare, okay, 25,000. Okay, reducing balancing method for 2 years. So 25,000 minus this. Depreciation of fixtures will be 40%, right? 40 divided by 100, multiply by, yeah, that's 10,000.
Yes.
Yeah, they said extra from the income statement for the year will be 3,600. Extra from the income statement for the year. Why is it 3,600? Yeah, provision for depreciation made was 16,000. Yes, so 25,000. She made the provision for 25,000. So it will be 25,000 minus 16,000, 9,000 times 40 divided by 100. Look at what they said here. There's 40% depreciation. Our trial balance was drawn up. The fixture is 25,000. Provision for depreciation is 16,000. So if provision for depreciation is 16,000, then it will be 16,000
minus 25. 25 minus 16,000.
10,000. Yes, 3,600. This is it. They said there's provision for depreciation, right?
Yes.
The provision for depreciation is 16,000. If provision for depreciation is 16,000, then 40% of 16,000 is what? 40% of 16,000. 40 divided by 100 is 0.4. 0.4 multiplied by 16,000. 6,400 minus the value of the 40%. You know, we have assets, 40% for the asset and 40% for the position for depreciation. 40% of 25,000 is 10,000. 40% of 16,000 is 6,400. 6,400 minus 10,000, 3,600. That's the depreciation of the fixture.
So you're going to get.
Do you get it or not?
Yes, you're going to subtract 40%.
Let me just explain it again. They said the trial balance is written as 25,000 for fixtures. Provision for depreciation is 16,000.
Yes.
Now they said we should prepare a relevant extract from capital income statement for the year ended at 30 June. So if we have to prepare the income statement, how do we get the income statement? The income statement should read expenses, yes or no?
Yes.
So what are the expenses? The expenses should be provision for depreciation, isn't it?
Yes.
And we have 40% of depreciation. For the fixture is 40%. For the provision for depreciation is 40%. Both, right? 40% of 25,000 is 10,000.
Yes.
Provision for depreciation for that asset is 10,000.
Yes.
Provision for depreciation of it is 16,000, 40% again. So fixture minus the percentage of fixture minus the percentage of provision for depreciation will give us our depreciation for fixtures. So 25,000 divided by 40% is 10,000. 16,000 divided by 40% is 3,000 is 4,600.
25,000 divided by 40. The
Minus
minus
16,000 divided by 40 over 100.
That's what give you the.
Yes. You get it?
Yes, yes.
So in our expense account, we have 3,600. Clear?
The overall value.
So in our statement of financial position, it will be 25,000 minus 3,600 will be our accumulated depreciation. Our net book value
Yes.
is it not provision for depreciation minus assets?
Yes, yes, yes.
Okay. How do you get our provision for depreciation? We have 3,600 minus 25,000.
Yes.
That's our accumulated depreciation. And that is what you take away from the cost to get your net book value.
But if you minus 25,000 from the 1,600, it will should not be 19,600.
It is
How is it?
25 minus 3,600.
Yes. It's not 19,600.
Are you sure?
Yes, it's 25,000 minus 3,600.
Wait, we have
I think it's 25,000 minus 3,600 divided by 40. That will give you the 5,400.
no, the difference between accumulated depreciation and cost is 5,400. It's 19,600. When you do it together, 3,600 is your depreciation of assets, yes or no?
Oh, if you had 19,600.
You had
Yes, yes.
you have the provision for depreciation. Remember, when we are calculating our assets, the historic cost minus provision for depreciation gives us our net book value, yes or no?
Yes.
Now, we have accumulated depreciation. Why do we have accumulated depreciation? We have it because there is a provision for depreciation. So if we have to calculate provision for depreciation, we have provision for depreciation is 16,000,
Yes, yes.
but we have our value for depreciation for 3,600.
Yes.
So that with provision for depreciation gives us accumulated depreciation. That means depreciation does not stop at 3,600. It ended at 19,600, which is 16,000, which is the provision for depreciation minus plus 3,600. Normally, if we don't have the accumulated depreciation, as our net book value is supposed to be 25,000 minus 16,000.
Yes.
But because we have to depreciate the fixtures and we have to depreciate the provision for depreciation, provision for depreciation cannot be constant. It is only the percentage that will be constant. So now that we have a constant percentage for fixture and a constant percentage for provision for depreciation, we have 3,600, which is provision for depreciation, yes or no?
Yes, yes.
But that is not the only provision for depreciation we
We
have.
have 16,000 also.
We have 16,000. So provision for depreciation,
So we add them both.
they become accumulated. Accumulated means add up depreciation. So add up depreciation minus the historic cost gives us our net book value.
Yes, I get this.
So your statement of financial position will be recorded as our net book value, which is 5,400.
Mhm.
Is it clear now or not?
Yes, it is.
Fixture is staying, which is 25,000,
Yes.
but it has provision for depreciation, which is 16,000. 16,000 of 40%, we got that. 40% or 25,000 for 40%, we got it. We differentiate it, right? We have our provision for depreciation. So do we leave it that way? We need the provision for depreciation. We have it already 16,000. You add it to it minus the cost. That gives your net book value. But when you don't have provision for depreciation at the beginning, you are making out your provision for depreciation. You take it away from the cost.
Yes, yes, yes.
It is like this because we have a provision for depreciation. Most of the time, we don't have provision for depreciation. If we don't have, we use our method, reducing balancing method or whatever method we use. Whatever we get, we take it away from the historic cost and we have our net book value.
Yes, I get it.
Okay. So disposal of non-current assets. Are you there?
Yes.
Because the purchase of non-current assets is capital expenditure, it is recorded in an account for the non-current rather than the purchase account. When a non-current asset is sold, it is a capital receipt. When you purchase a non-current asset, it is capital expenditure. When you sell a non-current asset, it becomes a capital receipt. That is the point. It's capital expenditure when you purchase a non-current asset. When you sell, it's a capital receipt. And it's recorded in the special account known as disposal of non-current assets rather than sales account. This is the point. When you are recording your sales of capital, you did not sell, it's not part of your sales. It is a non-current asset account, disposal account that you have to record it. You sold it, yes, but it is not part of what you are using. It's not part of your stocks.
What about your sales? It's
Huh?
not part of the sales.
It's not part of your stocks. So you should not record it as stock. You have to record it as disposal of non-current assets instead of putting it in your sales account.
So you
prepare a ledger for that.
So you're getting rid of that asset, that's it.
Yes. So you prepare a disposal account for it. So when a non-current asset is sold or disposed of, it was removed from the ledger record because of asset and depreciation of the asset are removed from the asset account and provision for depreciation account and transferred to a disposable account. The proceeds of sales are also entered in this account. It is quite likely that this account will not balance. This is because the depreciation was only an estimate of the loss in value. Only when the asset is sold can the actual loss in value be calculated. The difference on the disposal account represents either a loss on disposal or a profit on disposal. So, what do? As soon as you prepare your disposal account, the disposal account will not balance because it is not that you are selling something, it's an estimate. So it is either you lose or you gain. That's when we had 3,000 something, 3,200 and 3,000. That represents a loss. You estimated it's a profit.
Yes,
Yeah, your estimate was 3,000 to be sold, to sell it 3,000.
Yes.
But at the end of the year, you're able to sell it for 3,200. So your disposal account there will represent a profit. Profit on disposal of assets, not profit on sales.
Yes, yes.
Is it clear?
Yes.
So the entries are summarized. On the date of sale, credit the asset account and debit the disposal non-current account with the original cost of the asset. So this is what you do. When you are about to dispose the asset, you have to open a disposable account. Yes or no?
Yes.
Because you are opening the disposable account, that account is receiving that asset that you are disposing. Yes or no?
Yes.
So that means that account should have a debit balance. The asset you are selling, maybe it's machinery. The machinery account will have a credit balance because the machinery is selling out to dispose.
Yes.
Is it clear?
Yes.
With the original price, that's the storage cost. Now, there is provision for depreciation for that asset, yes or no?
Yes.
So the provision for depreciation account, you have to debit it because the amount is kept aside for depreciation.
So what do you mean with the original cost price?
Historic cost.
No, how?
25,000.
No, like 25,000 is the assets or the disposal? It's in the assets, right?
Asset.
Yes.
25,000 is asset.
So I credit 25,000.
Yeah.
And in the disposal, is it the same? Debit 25,000.
Credit the asset account and debit the disposal account with the original cost price.
So yeah.
The cost price is what you sell, you credit. Debit and credit. The original price, that's the total cost.
Oh yeah.
When you are disposing,
yes,
you open a disposable account, right?
Yes.
You are selling that asset. At first, your current asset, your asset account for equipment that you are disposing.
Credit.
Yes, because you are selling out.
Yes, yes.
The disposable account for machinery will be debit balance.
The same amount.
Of the amount, yes, the same amount.
The original amount, yeah.
Now you go to the provision for depreciation account. For provision for depreciation account, you debit provision for depreciation account and you credit the non-current account for disposal,
Yes, yes, yes. Yes, I get it.
the amount you sold it.
Amount you sold with it. It's not the 25,000. It's
No,
after
the amount you are selling now.
it's after the appreciation.
Yeah. Is it clear now?
Yes, yes.
So you credit disposal account, we talked about that. At the end of the year, the difference between them, you transfer it to your non-current account in the income statement. So the difference maybe is 3,200 is the difference. That goes to your income statement. You know, you have the value for the assets.
We do an example.
Okay, I think we have example at the end. We have,
I have it.
yeah. Okay, let me use this to explain to you. On July 1, 2023, she purchased fixture costing 25,000 and paid by check. She decided to depreciate the fixture using the reducing balance method. The provision for depreciation for of fixtures account showed a credit balance of 21,760. So there's provision for depreciation account. So the first thing here is that the fixture account will have a debit balance, yes or no?
Yes, yes.
Your fixture account, you are selling that fixture, yes or no?
Yeah.
But the first thing is that both accounts we have both fixtures account we on the debit side we have the amount you bought it, which is check, bank, and the disposed amount, which is the same amount that you want to sell it. The amount right now.
Yes, yes.
The fixtures was bought for 25,000. Your fixture account will have the debit entry for bank,
Yes.
the credit entry for disposal,
Yes, yes.
because that fixture is going to be disposed. You prepared your nominal ledger for fixtures account. Now provision for depreciation account. They said the account has a provision for depreciation account of 21,760. You debit disposal account, and because 21,760 is receiving disposal account. Provision for depreciation account I'm talking about now.
Yes, yes,
So you debit provision for depreciation account, disposal for the amount. Then you balance both down to the credit side. That is the point that I'm making. As soon as you want to dispose an asset, the first thing is you open an account for that asset.
Yes.
Fixture, equipment, machinery account. The debit side has the amount, bank or cash. The credit side has disposal.
That's the same amount.
The same amount.
Yes.
Now, provision for depreciation was stated.
Yes.
You open a provision for depreciation account. On the debit side, you have what has to be disposed. On the credit side, you balance it. That is the.
Yes.
Then you are disposing what? That asset, yes or no?
Yes.
Now the disposal account itself. The first account that was opened was the fixtures account, the non-current account. The second one is the provision for depreciation account, which states the amount of disposal. Yes or no?
Yes,
now the third account will be the disposal account itself, which will be on the credit side. You are disposing it. So if you are disposing, how much are you disposing it? 21,760. Yes or no?
Yes, yes.
And they said it's using this reducing balancing method of certain percentage. So that means the percentage divided by the total amount. You minus it from it. So whatever you get minus 25,000 is it goes to your income statement. Fixture is 25,000. It stays on the debit side of disposal account. That is what you are selling, yes or no?
Yes, yes.
But how do you balance it up? You balance it up on the credit side because everything that happens in this transaction of disposal happens on the credit side. The asset is staying. The asset is staying, waiting to be sold. Yes or no?
Yes, yes.
The asset is 25,000 in your disposal account because we cannot open a sales account. We have to open disposal account, disposal of fixtures account. The provision for depreciation is 21,760. The percentage used is the reducing balance method, maybe, yes, 3,100, provision for the percentage. Then 21,760 plus 3,100 minus 25,000 gives you the balance of the income statement. Do you get it now? 21,000 plus 3,100 minus 25,000. The balance is what goes to your income statement.
Where did you bring the 2,000?
40% of 21,760.
Oh, yeah.
We have it there, right? You have it here.
I know we have it, yeah, for 3,100.
Yeah, they said Kavika sold all the fixtures on credit to traders. You sold all this, you sold them on credit to this person. So whatever you sell, you still sell the fixtures, right? Yes. Those they are still all sold. Some are sold apart, then the provision was made. So you have them together. The difference between them gives you 140. The provision for depreciation, yes, for fixtures. And certain fixtures were sold too. Yes or no? Certain fixtures were sold for 3,100. Yes. You had it with the value of the fixtures. Yes, yes. Okay. That is what you have to take away from the fixture. The remaining goes to your income statement as provision for depreciation. Is it clear or not? Yes, yes. Fixture is depreciating, but the business was able to sell part of the fixture for 3,100, excluding the 21,760. So are you going to forget about the 3,100 because it's part of the fixture? Because it's part of the 25,000 fixtures that was bought. 21,760 is left to be disposed. 3,100 has been disposed. So you have to add them together because that's the total that is going to be disposed. Yes, sir. So the total minus 25,000, whatever is left goes to your income statement. Yes. Is it clear now? So that was about depreciation. You have the questions you don't have time to do that.